It's Brian Preston, the money guy.
Look, when you're in your 20s and 30s, you want to make sure you're investing in yourself by building an army of dollar bills that can grow. So you're at this dilemma, like, do I pay off student loan debt? Do I invest in a Roth IRA? The order of operations turns into a big question mark.
So we thought, okay, well, let's make a flow chart, right? Let's make a decision matrix around how do I approach knowing when do I build my army of dollar bills versus when do I pay off my student loans.
Now, I love this because it let me and Bo show off in multiple ways. First, you get to flex and show that you got some fancy definitions that you know with your CFA.
Yep.
Is that we try to come up with a system that said, okay, we want to take into account that you're young. So remember, the way we've always talked about our assumptions when we do these type of illustrations, 20-year-olds should be swinging for the fences on risk, especially because they're dollar cost averaging. So even if we have volatility is actually a good thing for our 20 and 30-year-olds, is because buying into down markets is great. But I think you can probably, even in down markets, because you're buying into cheaper and cheaper, you could probably expect in the long term of looking at your saving career, you probably could, if you're thinking about the S&P 500, make around 10% a year.
I think that's reasonable.
When you're in your 30s, you have to start dialing the risk down. Maybe you got kids, so it's 9%.
Yep.
By the time you reach your 40s, it's probably 8%, because once again, you're adding more diversification, taking a little more risk off the table. By the time you're in your 50s, we'll get to that, but when you have student loan debt, it doesn't really come into play that much. So that's our number. And then, Bo, this is where the term equity risk premium, what is that?
Yeah, so equity risk premium is essentially the additional return you get for taking on more risk in the financial market. So if you're someone out there who knows that you can go and get X% risk-free, whether that's in cash or CDs or something like that, treasuries, you can go get 2% risk-free. If you can go out and invest in something like, say, the S&P 500 and go get 6%, you would say that you have a 4% equity risk premium. So we said, okay, well, if we're going to give folks some rules of thumbs, we need to think about this because the risk-free rate changes over time, right? So it's not always a 4% risk-free rate. It's not always a 2%. But we were able to find, on average, that the risk-free rate stays fairly consistent.
It's somewhere between 3.5% to 5.5%. So we went conservative.
Yep.
We did 4%.
We did 4%. And so we said very easily, if you think about you're someone who can make 10% on your investments.
In your 20s.
In your 20s, and you have a risk-free rate of 4%, that means that your equity risk premium would be 6% above that.
So that's what, if you have student loan, if you're in your 20s and you have student loans that are charging you more than 6%, you probably want to focus a lot of your resources on paying that off early.
That's exactly right.
If you're in your 30s, because realize we dialed down that return just a little bit, if you take the 9% minus the 4%, now if your student loan rates are greater than 5%, go attack those things. By the time you're in your 40s, it's probably around 4%. And you notice we stopped there. It's because I don't want you to have, if you have student loans in your 50s, we're doing this wrong. So you got to be out of student loan debt in your 50s, because realize this, as you get closer to financial independence, I want you debt free. I just want to make sure that while you're in your 20s and 30s and that army of dollar bills can grow significantly and work hard for you, that we take advantage of that.
Absolutely. And don't miss here. So we're not saying that you shouldn't invest in yourself. We're not saying that you shouldn't even go have student loans, because some of us are in a position where maybe that's the only way that we're able to go out there and get a college education, get a degree. But if you are going to accumulate student loan debt, when you think about retiring that, you want to do it in the most efficient and effective way possible.
And I think there is going to be some people who are watching this that are on the other side of it. I mean, they have not built up a lot of student loan. They're looking for guidance on that. Remember, we give the guidance that try to come out of college with your student loan debt being less than your first year's anticipated salary.
That's exactly right.
If you can do that, that will keep you from choosing, because it's just like, I have a daughter that's probably going into something with the arts. And I've had a conversation. I said, is it going to bother you if you don't come out making great money? And she goes, no, I kind of understand that. So we're going to make sure that her portion of participation in student loan debt and other things, that she doesn't come out with greater debt than what she probably will make in her first year out of school.
Yep.